Marketplace Books and Traders Library are proud to present the Trade Secrets video series. When you're looking for new ways to boost your trading returns, these best-selling resources will give you the tactics, strategies, and ideas that will transform your trading. These books and courses give you the knowledge of highly respected educators like Jeff Greenblatt, author of Breakthrough Strategies for Predicting Any Market, Charting Elliott Wave, Lucas, Fibonacci, and Time for Profit. Oliver Velez, author of Strategies for Profiting on Every Trade and 5 Tactics That Beat the Market. And Tony Turner, author of A Beginner's Guide to Short Selling. All of the courses in our Trade Secrets video series are supported with an educational online manual. With this manual, you can observe the charts up close. And with our website, you can access this valuable resource at any time. Just log in at traderslibrary.com/trade secrets. Traders Library and Marketplace Books also feature a myriad of interactive multimedia courses in our Traders Education Corner. These course books come complete with the text, interactive test questions, online video presentations, glossaries, and downloadable charts. Make sure you visit traderslibrary.com/TLEC to learn more. To make sure you get the best price on these profit-boosting DVDs and all of your other trading resources, go to traderslibrary.com and sign up for our Rewards Weekly program.
Thank you, everybody. It's an honor for me to be here tonight, especially in the presence of greatness. Not just you guys, but the company that I'm in, the Nissans and the Tony Turners and the McMillans and everybody else. So I'm glad to be here. So thank you. As John had pointed out, I started up Underground Trader about 11 years ago, and the underlying theme, aside from being underground, was the fact that back then, the good old days, you had your fractions and market makers, level 2, and the whole level 2 thing was the mystique. Level 2 was supposedly an inside tool that you could use to be able to actually gauge the depths of the buyers and the sellers and spot an axe market maker when he would want to make himself transparent and whatnot. So I delved into level 2 really, really deeply, and I took that information. I put a stochastics on a 1-minute time frame, and amazingly, I was getting some very predictable oscillations. And putting those two things together, put that into a little mini system, and it was very good. It was very consistent. It worked great, back then. But as the markets have evolved, all right, and that's actually the wrong word, okay, because evolution implies an improvement or moving forward, all right. Still the same old game, all right. Little guys are still getting screwed, all right. Instead of axe market makers and whatnot, you've got dark pools and flash orders and sub pennies. So the better word I'd say is mutated. Okay. So as the markets have mutated, I've had to basically continue to calibrate and refine the system. And after a decade, I believe that the system has pretty much come around full circle. Hey, quite a coincidence, full circle. And a circle pretty much implies a shape that is void of any voids, all right? And it's you start at, when you draw a circle, you start at one point and you pretty much end up at the same point, So the question is then, if you start where you begin, if you know the beginning and the end, what was the point of the whole thing? Well, it's the whole journey. It's the whole journey. It's the evolution. And that's a true definition of evolution, to actually make that journey and improve the process, which leads me to, math, preschool math, actually. When you hear A plus B equals C, all right, and if I tell you A is 5 and C is 8, okay, well, what would B be? 3, right? Okay. So 5 plus 3, A plus B equals C, okay? Yellow and blank make green. What would blank be, guys? Blue? Right, blue. Okay, so A plus B equals C. That's the basic formula here. All right. Now, when it comes to trading, it's pretty much the same thing too. All right. A is your starting point, and C is where you want to end up. You want to be profitable. All right, consistent, growing profits. Okay, and yet, people tend to focus so much on the C part. Okay, the profits. Almost to a point where it's detrimental. When you're looking at your P&L statement and your blotter all day long, and you've minimized it down to a point where every tick you've got your eye on that P&L blotter. Okay, that's where it becomes detrimental, and that's where you're not understanding the true essence of the game, so to speak. See, B is the process. Okay, so you know where you know what C is, and you know where the beginning is. It's the B part. It's the process that people have to focus on. How they say, focus on the trade, not the money. Okay, that's a perfect example, because traders tend to focus too much on the C, okay, and thereby the B is minimized. And because they minimize that B part, the C doesn't really happen either. Okay, in fact, all they got is A. All right, so anyways, my point is B. All right, B. That's what we want to focus on. All right, B, the process here, and the whole journey is pretty much about B. Okay, that's what B is. It's a journey. It's about a process on many levels, not just your own journey within yourself and finding out that, hey, you know what, I can't swing trade for crap, okay, or I can't scalp. I'm just too laid back. All right, these are just little things that you learn about yourself throughout this journey. Okay, throughout this journey, you'll also realize, every one of you who's trading, you have a lot of data on yourself. Every one of you has a little threshold, if where you fall red to a certain level, $300-400, you don't sweat it. Okay, but there's that level where once you hit it, $700, then all of a sudden you start doing irrational things, and you're doing irrational things. Okay, it's that it's where you start to go. It's where you start to tilt. All right, and you have that data. All right, every one of you has that. You could probably just tell me, hey, Jay, when I'm down, $300-400, it's no big deal. But when I start to get to a certain point, then all of a sudden the rules just get thrown out the window. Okay, and that's part of your journey. And that's something that you all have to acknowledge. All right, in private if you want. All right, but make sure that you include that as you're putting your equation together here. All right. So anyway, like I said, I don't want to beat a dead horse, but B. All right, B is what we want to be focusing on, and that's what we're going to focus on tonight. So anyway, now going back one more time to the whole C thing, all right, which is the profits, and that's what everybody wants, and they want that consistency with the profits. Meanwhile, not putting the real emphasis on the B part. Okay, what tends to happen is when people blow out their accounts, or they blow out their accounts for one reason or other. Something interesting tends to happen. They actually start to get a moment of clarity, where when they're at a point where they can't trade, okay, and the tension and the stress that's been put upon themselves, okay, inadvertently, to focus so much on the C, when that's taken away, something interesting happens. Clarity comes in. Clarity comes into play. all right? When you don't have the ability or you can't trade, your broker cuts you off, you cut off your internet access, whatever, all right? That's when you start to things actually start to sink in, all right? And that's, once again, that is an indication of you accepting the B. Now, the thing is, we want to get you guys to understand, to focus on the B before it's too late, okay? But hey, you know what? Pain is the greatest teacher, all right? And I think everybody should go through a blowout or two, okay? That's a joke. All right, so going back to B, all right? B is composed of three things as it pertains to trading, all right? Methods, the mindset, and management, okay? When it comes to B, everybody pretty much focuses so much on the methods portion. Everybody's looking for indicators or a system that's going to work in all markets, okay? Well, I got news for you. The reality is that methods are pretty much like a weapon, okay? And, they say you can't take a knife to a gunfight, okay? But it depends if you're fighting underwater, all right? It depends on the context, okay? So as far as methods are concerned, you just need to make sure that, your methods they work part of the time, okay? The other thing you have to keep in mind is that it's the environment that you use these methods in, okay? When the and I'm going to go over the type of environments, because as much as we want to restrain from blaming the markets for our actions, okay? The reality is that the markets will play a major role in your success as a trader. Now, when it comes to your actions, you're the only one who can control your actions, obviously. And what we want to do is get to a point where you can identify the markets that are the most fertile, okay? They have the best, most fertile climates, so that you can take a method and place it and use it in an environment where it's going to be effective, okay? But more importantly than that, when that environment shifts, okay, when it goes from a fertile market to an infertile market, you want to alleviate those methods. You basically want to protect your weapon. You don't want to keep using it and breaking it down, okay? So you want to basically step back and understand that this weapon is not going to be that effective in this market, and be conscious of that, because it's very easy to take, to try to take one, to be very linear and take one method or one system, or for example, just taking a moving average crossover and saying, hey, this stuff's great. And then, the next day, it's like, whoa, this stuff's worthless, okay? When I was developing my system, the stochastics, going back to the stochastics, the 1 minute stochastics, and if you're not familiar, stochastics is composed of two oscillators. You have a lead and a laggard oscillator, and it's plotted on a scale with a 20 band and 80 band. 0 is the lowest, 100 is the highest, and basically the basic rule of stochastics is when the price comes down, the oscillators come down, okay? And your basic buy trigger is when the stochastics cross back up through the 20 band. Okay, that just implies that the stock's been oversold and the momentum is reversing, all right? So you buy the 20 band crossovers, okay? And a lot of times it's going to work. It's going to work. And sometimes it's going to work really good, okay? But there are also going to be those times where you get that crossover and you get it's identical on the stochastics, but as far as the price is concerned, it pops up, you get a 10-cent pop, and then they just rug pull it for 50 cents right beneath your feet. And at that point, it's very easy to say, wait a minute, oh man, I've been duped. I've been duped. This is a worthless indicator, okay? And when you use something in a generic sense like that, in a generic role, because it's a generic tool, okay? I didn't invent it, I just use it, okay? But it's generic. And when you use it in a generic sense, you open yourself up to being disappointed. Same thing with the moving averages. People say, well, moving averages are, they're pretty worthless because it's a lagging indicator. Of course it is. It's a moving average. You can't have an average, without already having the data, all right? So with my little journey, with the moving averages, what they showed me was they actually quantified what a trend was. Okay, in my system, I use a 5 and a 15 period simple moving average. And basically an uptrend is a higher high followed by a higher low. All right, well, that's indicated with a 5 period being the higher high, the 15 period being the higher low. The space in between the two is called a trend channel. And if they're moving up, okay, if they're moving up, that's an uptrend. If they're moving down, that's a downtrend. Very simple, very simple. And using just that generic system with the moving average crossover, that's going to work some of the times, all right? But then there are going to be times where you're going to get a crossover down, and you say, it's a breakdown, let me go ahead and short it. As soon as you short it, it'll cross back up. You're like, oh man, all right, let me reverse it again. And there are going to be days where you're just going to be chopped to hell, and you're just going to say this is worthless too. And you're going to keep going on, and you're going to keep going on. All right? Now, if you take two generic items like a stochastics and a moving average price chart, all right, well, now you're starting to make some progress here. This is evolution. All right? So taking a momentum indicator like the stochastics, that's going to show me that this stock is overbought or oversold, but then using the moving averages as a price indicator, or more so a roadmap, okay, a roadmap, that all of a sudden explained a lot of things, all right? When the stochastics fell, crossed over, and bounced back up, why was it that I was getting, and this is back in the days, a 2-point pop on Applied Materials in the morning, but then in the afternoon when I saw the identical thing, AMAT would pop maybe a 1/4 point and then drop 3/4 of a point. Well, the stochastics alone didn't tell me that. But what the moving averages told me was that, wait a minute, in the morning, Applied Materials was in an uptrend. And what had happened was the stock had pulled back to a moving average support. The buyers held it, and when the stochastics bounced back up, the stock resumed its uptrend. Okay, and that was more it's more beneficial to buy a long on an uptrend. Vice versa, in the afternoon, when the identical stochastics formation happened and the stock barely popped up before it sank right back down when the stochastic slipped, well, the reason for that was because the stock was in a downtrend. Okay, I was going against the trend, and it bumped right up against the resistance, and then when the stochastics lost its momentum, it proceeded to tank pretty hard, and it tanked with the trend. So now I realized, well, okay, so if I have a moving average indicator, okay, which is going to give me the roadmap, like I said, stochastic is going to give me the momentum to time this. Now this is something interesting. This is something special, all right? And see, this is how the journey starts. As the markets mutate, as I said, as the markets mutate, the indicators, they too you have to calibrate and refine them, all right? So what I did was, the stochastics gave a certain type of a pattern when a moving average was trending, and I had noticed something. The lead stochastics, when a stock was uptrending, okay, and the stock pulled back, oftentimes the stochastics would stall out, and the lead stochastics would look like it was going to cross right back down. But if that 5-period moving average support held, and it bounced, the stochastics underneath would actually form a type of wedge. The lead stochastics would actually slope up, okay? And that was very interesting because when that happened, it triggered an explosive move to the upside, okay? And so I coined that thing a mini pup, all right? There's a power uptick breakout. And with that mini pup, okay, the beauty of this whole thing was that, well, that 5-period moving average lead support on the uptrend was tested. It was actually tested. It's not something where I just came up with a number out of my head and said, well, Apple should not break this price, or Apple should hold this price. No, this is a price where the market participants came in, the bears, the sellers came in, the shorts came in, they tried to short it, take it down. They couldn't. There's a tension there, and then, bam, it sloped back up, shorts got squeezed, buyers came in, and beautiful. And the market showed me that. Okay, that's a market-proven support level. And it's a dynamic support level because as time goes on, the buyers are going to keep bidding it higher. Now, the other thing was that, I added more stuff, Bollinger Bands, okay? The funny thing is that these Bollinger Bands were actually very nice levels to use as price targets. When the stock got squeezed up, okay, the Bollinger Bands actually gave me a nice target to aim for as the stock moved higher. What about my trail stop? Well, my trail stop's simple. Okay, the whole reason why the mini pup formed was because they couldn't break that support. But if they do break that support, what am I going to do? I'm going to get out. Okay, so that 5-period moving average is a live dynamic moving trail stop. All right, so there's your mini pups, and then, well, you know, I took that from a 1 minute, okay, and I added a 3 minute about, what is it, 2 years later. I'm real slow. Okay, so what do you think happened 5 years later? I decided to add an 8 and a 13 minute, all right, and then a 60 minute, and then something interesting happened. I realized that this mini pup pattern that forms great even on a 1 minute time frame. It works great on a 3 minute time frame. Well, that's going to work great, and it did work great on an 8 and a 13 minute time frame. Okay? In other words, what I realized was the pattern was linear. So whatever happened on a 1 minute would apply to a 3 minute, 13, 60, a daily, or a weekly. All right? The only difference was the playing field, or the scope. The scope of the price range was greater. Okay, so all of a sudden, a lot of things started to click. You know, whenever someone asks you, you know, if a stock is in an uptrend, all right, well, you have to be more specific, because a stock can be in an uptrend and a downtrend at the same time. It depends on the time frames. A stock can be in a downtrend on a 3 minute time frame, okay, but still be in an uptrend on a daily time frame. All right, so basically when I saw, you know, a 60-minute mini pup, okay, initially I'd be like, wow, that's great, let's just jump in right now. The stock would collapse, you know, and I'm saying to myself, well, this is kind of odd. But as it turned out, another word that I learned is called convergence. In other words, a 60-minute cannot form, and you can't see the explosiveness of a 60-minute mini pup break out until your shorter time frames, okay, are aligned with that. In other words, the momentum on the shorter time frames have to align. The stochastics have to cross back up on the shorter time frames, okay? And that's what causes a solid explosive move. In fact, if you get 3 or more of these time frames and put them together, you have what's known as a perfect storm. And thus is the evolution of what I call a perfect storm pattern. And so the other thing that this created for me, okay, first I learned linearity, all right? A pattern that works in one time frame is going to work in all time frames, okay? Convergence, when the pattern or the direction, okay, is lined up on the time frames, okay? But it also gave me something else. When those things come into effect, it gives you something else. The wider time frames, if you can consider them like a Doppler radar, and this is the perfect analogy, okay, the wider time frames are superior. I mean, they're deeper. They show more depth. A wider trend, a wider mini pup, ultimately is going to continue, and the trend is going to form and break out. Meanwhile, the shorter time frames may be in their own little, you know, hot mess. Okay, but once they turn around, the upside is going to be explosive. So it's kind of like, then I realized it's kind of like, well, hey, if the 60-minute and the daily is in a mini pup, okay, that's telling me we're going to break out to the upside. But why is the stock down? It's because the 3-minute stochastics and the 8-minute may be down. So what that tells me is it's as if it's sunny right now, right out front in front of my house. But the weatherman's telling me there's a hurricane coming, 100 miles down the road. You see what I'm saying? It's a Doppler effect. So what that gives me is the power of foreshadowing, okay, or foresight, for foreshadowing. All right. So what does this all mean? Well, what did we do? I took simple components, okay, and I created napalm. All right. How do you make napalm? Styrofoam and gasoline.
Greasel and gasoline.
What's that?
Greasel and gasoline.
Exactly. And that's basically what it was. Taking very basic components, okay, refining them and putting them together, all right? Now, it didn't just end there, okay? The potency of the napalm, okay, and when and what environments it's more effective in. See, that's all part of it, all right? It's never going to be just one aspect because there's this thing called context, okay? And as a trader, the most important context you have to be absolutely aware of is the markets, okay? And going back to the whole mutation thing, yeah, you know, the argument can be, hey, the markets are more efficient, you know, prices, the spreads are thinner, and consumers are getting their money's worth or their value, okay? You know, it's BS. Don't tell anybody, but it is. All right, the games are still around. They've just evolved now, you know? If you all ever see your time of sale screens and you see trades go off with 4 decimal places over, you know, 4 decimal places over instead of 2. All right, it's illegal to have 4 decimal places over when you go through the exchanges, okay? There's these things called dark pools, and these dark pools, well, that's pretty much the same thing as what Inca or Instinet was back in the old days, where the retail guys don't have access to it, okay? But the big boys, they do, and they can trade amongst themselves. It's the exact same thing. Instead of Inca or Instinet back in the old days, now they're called dark pools, all right? And you've got the algorithm programs that's going to come in, and they will swoop in 4 decimal places over within a penny spread and just buy and sell, buy and sell, buy and sell, okay? So if you're, you know, if you're a trader or anybody, basically, that, you know, the momentum's coming down, mini inverse pop on the stochastics, this is great. Hey, let me throw my orders in there, let me sprinkle some in. And you realize, I'm not even getting hit. Look at all these trades going off. Well, that's just the programs that came in and just stole your liquidity. You see what I'm saying? So you're still getting screwed, all right? So full circle, we're right back at the same spot, okay? Little guys are still getting screwed, but, you know, once again, we have to adapt, and we gotta calibrate, you know, and the only way you fight these guys is, well, you gotta revert to a wider time frame, okay? The shorter time frames can really chop you out, all right? The other thing that's happened with this mutation with the markets is, well, the fertile periods have also, fertile periods have gotten less fertile, okay? The windows of opportunity have dropped. And once again, it's not just dark pools, it's the algorithm trading. You guys have heard of the flash trading, okay? You know, that's like trying to put in a 500 shares of sell on SanDisk, you know, and all the bids just jumping off, you know, during lunchtime, okay? It's all BS, all right? But it's the same thing. It's just been masked under new disguise, all right? So anyway, not to depress you all, everybody's, where's my tissues? I just want to pass one around to everybody. But, all right, so anyway, we're on top of it, okay? Like I said, it's nothing new. It's just it's the same old story, just under different guises. All right, and the other thing that I'm noticing too is a lot more mistakes out there just to screw up the charts. So I kind of take that personally. So, all right, anyway. So I went over the methods, okay, in a nutshell, all right? But the core of my methods are just that, the mini pups, okay? And once you understand the concept of the mini pups, okay, then it's just adding on, it's just calibrating it, okay, and adding on the other tools that are gonna just make it more effective, all right? Now, I wanna touch upon mindset for a couple hours, actually, but I only got a limited amount of time. So I just got one word for you, T-I-L-T, tilt, all right? If there's any poker players or pinball players, pinball machine enthusiasts, whatever, all right, tilt, okay? That's a position that you don't want to get to, and that is a position that's very easy to be fall into as a trader, okay? And it doesn't often come just immediately. You don't just get smacked in the gut with a very nasty trade and a very nasty loss, all right? Tilt comes, the most severe type of tilting comes very slow and very subtle. Very, well, I'm not gonna say slow, but very, it's like death by 1,000 cuts. You know, when you are in a infertile environment, and you constantly find yourself just getting chopped. Okay, and once again, especially if you're a scalper, all right, a lot of times it is you're in, and you're in 1,000 shares. You're not looking for 6 cents. You've got the mini pup. Everything's lined up. You're looking for at least 15, 20 cents. Gets that little 7-cent pop, and then the bids, everything just gets pulled away. All right, and you get stopped out, and you get stopped out. You may get, and then you decide, all right, fine, 7 cents is fine, but let me just up it to 2,000 shares, so it's more like 14 cents, right? So, all right, so hey, that worked that time, so you got your 7 cents, all right, and then guess what? You get chopped again, and back and forth, back and forth. But meanwhile, now at that point, you're just looking at your P&L statement, you came into the day strong, you're like, I don't care about the P&L, I'm just going to worry about the trade, man. Worry about the setups, I got my mindset, Well, by dead zone, you're sweating, you're sweating. And you're like, God, I just need to, let me just add some more shares, And see, that's what happens, and you slowly add. The market usually is fertile in that first hour, all right? It's fertile, but then as the volume dries up, okay, and the ranges get more tighter, all right, the environment gets more infertile. And the problem is that most people go on tilt, okay, gradually, and then when they actually go on tilt, it's during that infertile period, okay, where at that point, you're not going to make money. And when you do make money, okay, it's not going to be enough. So what do traders tend to do? They tend to add more shares. And the problem is with these dark pools and with these flash programs especially, your liquidity is basically shooting yourself in the foot. Just like that, because now all of a sudden you've given your transparency away. See, the name of this game is to find transparency before it becomes too transparent, number one. But number two, nobody's perfect, okay? No one's perfect. Well, the algorithm programs, they are, okay? In fact, the computers, all right, they seek perfection, all right? As a humanoid, all right, you have to understand that it's about not showing your flaws. And if you're going to show your flaws, just, if it's inevitable, and everybody's going to show their flaws at some point, okay, you just want to make sure that it's not very significant when they do show, okay? The market will crack you open, and your flaws are just going to spill out. All right, that's what it does. The market loves to give you, a quarter, knowing that it's going to get $1.50 in the end. The end of the day, end of the week. All right, but it's going to give you a little something to keep you coming back. Okay. In fact, the worst type of losing days, for myself, and y'all don't have to admit, we got you on camera, but we only got the back of your heads. All right, but are those days where you start off with profits, with nice profits, and you gradually give them back. It starts off gradually, and then after a while, by the end of the day, you're a madman. You are like, oh, I still got 6 minutes left, and you're just throwing the Hail Marys. And then, then you're like, oh man, all right, I got till 8. Okay, there's no volume going on, or you know what I'm saying. Okay, so everybody's been there. All right, everybody's been there. It's a matter of acknowledging it. All right, knowing when you're in that tilt mode. Okay, and the other thing is, how do you combat tilt? Okay, that's really the question. How do you combat tilt? All right. Now, for those of you who were prudent enough and got the book, okay, there is a chapter in there called The 3 Remedies for Affliction. Okay, and this only applies to trading, right? But actually, it doesn't. It's linear. Okay, 3 remedies to affliction: roadblock, counteract, or diffuse. All right. And just to give you an example, to roadblock basically means if you're let's just take the analogy of drivers. I mean, look, bottom line is some people are just lead foots and aggressive drivers, and some people are just super defensive drivers, and regardless of how many signs you put up there, how many tickets you issue, all right? They're just going to be that way. You just can't change the nature of people. So if, for example, let's just say, someone someone who's close to you is a lead foot, is an aggressive driver, okay? Well, how do you prevent them from, let's say, taking a turn, off the ramp, at 100 miles an hour, which they normally do? How do you prevent that? Do you tell them, to please slow down? No. You just put a roadblock up there, okay? If you had that power, all right? Or you just pave it over. You see what I'm saying? In other words, don't try so hard to change yourself. When they say, hey, you got to be more disciplined. If you're not a disciplined person, all right, screw it. You're not a disciplined person, okay? The point is, block the access, all right? Block the access. And a lot of times, that's done for you. It's called a margin call, okay? But prior to that point, all right, whether you schedule, whether you schedule your day job after that first hour of the open, all right, there are lots of ways to roadblock yourself, okay, voluntarily. That's a key word too, voluntarily, all right. So that's roadblocking, all right. To diffuse, all right. Well, basically to diffuse means you pretty much you minimize the effect, the resonating effect, of that action, okay, or of the consequence. You minimize it, all right? Well, in trading, the way you minimize something like that is, practice on a simulator, see? That way, you lose on a simulator, well, it's not real cash, okay? So you diffuse, all right? And then you've got counteract, all right? Now, counteracting is, that's more aggressive. That's where that takes more effort, all right? Just off the top of my head, to counteract is, it's basically you see yourself going on tilt, you punch yourself in the head, knock yourself out, punch, pull, grab your computer and throw it out the window, all right? Counteract it, okay? But that's what I'm saying. And just in that vein, all right? But those are the 3 remedies for affliction. So going back, what I was talking about, the tilting, okay, no, that results in what? Losing a lot of cash, losing your capital, your ammo, so that you cannot proceed to trade, okay? You want to avoid that. And the best way to avoid that, like I said, the 3 remedies for affliction. All right. Okay. So anyway, moving forward, management, and that's basically where you pretty much apply. You temper the methods, okay, with the mindset, put them together, and that's managing, okay? Not just executing, okay? It involves, with the methods, it involves the filtering process, all right? As well as, executing, as well as allocating your shares properly, okay? And the most important thing when it comes to management is the preparation, okay? Preparing prior to not just your trade, but prior to the trading day, okay? There's a saying that's beaten into the ground, what do they say? Plan your trade, or plan to lose, or trade, something like that, all right? But the point is that when you do your research ahead of time, and I'll show you how you do it, okay? Basically, the bumpers, and that's what I call all the levels, they're bumpers, okay? It's just like a big pinball machine, all right? The bumpers all line up. Basically, the roadmap is already planned out for you, okay? All the levels, support resistance levels, they're all laid out for you, all right? As far as the stochastics, the mini pups, when you spot them, you already know, hey, if there's a mini pup, I know 2 things. I know that the 5-period moving average is going to be a support, and I know that the Bollinger Band is going to be a target. One or the other is going to hit, okay? End of story, all right? So you know that. When you know that, okay, that's when, depending on the time frame, if it's a daily time frame, that's when you know I need to watch the intraday time frames to see when that's going to actually trigger, when the sleeping giant's going to awake, okay, and that's going to follow through. The other thing is when you actually make the trades, okay, what what I tell my people a lot is, I know that it's easy to watch for something and scan and watch something set up, and then when it happens, to jump right in. Okay, and unfortunately, a lot of times what that causes is impulse entries. Okay, oftentimes chasing an oversold 1 minute stochastics, so that as soon as you get in, all right, it may pop a little bit, but it pulls right back. Okay, and oftentimes if you're not aware of the overall trend or anything like that, you'll get chopped right out. Okay, the other way to do it is to throw your try to get most of your fills, longs. If you're going long, try to get most of them on the bid. Okay, try to sell, even if you chase, try to sell most of your exits on the ask. All right. Now, if a stock is raging up, trying to get it on the bid that's a hard thing to do. Okay, understand. But if you actually think about placing your orders on the bid and the ask ahead of time, in other words, if we know that RIM is in a 15-minute uptrend with a 15-minute mini pup, okay, we know the 15-minute 5-period moving average is a support. That's the whole basis of the mini pup. Okay, so RIM may be trading 75 cents above that 15-minute 5-period right now. Okay, but if you throw it in on the bid, 10 cents above that 15-minute 5, okay, you may not get hit. Okay, but you also may get hit. But what the whole process of doing that, okay, it inadvertently forces you to actually prepare ahead of time. Do you see my point? Okay, so when you see a 15-minute mini pop, and then the 5 minutes starts to turn back up, or whatever, or the 5 minutes coming down, okay, you already know ahead of time, where these levels are, as opposed to just scanning, seeing one time frame and stepping right in, and then you're like, oh no, I didn't see this thing coming down. Okay, so that helps. It helps you be more prepared. Okay, and when you get more prepared, then that's when you can scale your orders in as well. See, getting hit on the bid is great. All right, now, you want to make sure that as you get more comfortable, okay, you should be able to actually scale it in as you get to know a stock. Okay, you'll get to understand where their wiggle rooms are, what the wiggle room is going to be under certain conditions. What levels are going to just be a de facto support resistance level. Okay, for example, Apple, RIM, the SPY. Okay, if you ever notice, you'll notice that every 30-cent level, okay, is just a sticking point, a speed bump. All right, on the way up or on the way down. That 75 cents level, always a speed bump on the way up or the way down. It's just a phenomenon. That's just how they trade. Okay, these are the little nuances that you'll know. If you don't, I'll tell you. Don't worry about it. So, all right. So that's the management aspect. That's just and that's putting everything together. Okay. So, I think we went over this part. Everybody knows how to make napalm now, right? All right, so let's go to the basic tools then. Okay, now I went over the mini pups and the core of the methods. Everything revolves around the mini pups. Okay, but let's break it down into actually what makes up the tools, what makes up the mini pups. I had mentioned that the 5 and 15 period simple moving averages. Okay, that's the moving average price chart. Okay, that's the roadmap. Okay, it's a 5-15 period simple moving average. I also throw in a 50 and a 200 period simple moving average, and they don't always apply. But the wider the time frame, the wider the moving averages, okay, the more sturdier that price level is going to be. All right. I used to say stronger, okay, but I like sturdier better because sturdy can mean it can be annoying, which is what it also is too. It can be they can be very annoying if you're on the wrong side. And then the Bollinger Bands. Upper and lower Bollinger Bands. Envelopes are set to 20 periods, 2 standard deviations. Pivot points, if your charting system has those, then use them. You don't need them on every chart because the pivot points are static. Okay, they are static. You can find the formula on undergroundtrader.com/pivot points. All right, if you need that formula. But most platforms have the pivot points. The volume bars, you only need those on, I just keep those on a 5-minute or 3-minute chart. I know that I'll make more use of them down the road, because I know that there's some correlation between volume and price. But I'm actually trying to develop a stochastics volume bar oscillator or something like that. I'll see you guys in another 10 years when I get that figured out. All right, and as far as the stochastics oscillators, or the stochastics, depending on your quote platform, okay, if it's Realtek, there's 5 inputs, 15.5.2, and then a 15.3, okay, for the percentage, for the slow stochastics and the fast. But most systems like eSignal, Cobra, you just pretty much use a 15.3.5 input, okay, and just pick the slow stochastics, and that'll give you 2 oscillators, and everything will work out. All right, so this is what the basic stochastics moving average chart looks like, okay, and this is the core chart. All right, you've got, once again, you got your moving averages up top, okay, and you got your stochastics on the bottom half of the chart. Okay, and this is a very dangerous weapon. You must treat it nice. All right, do not use this or overuse this weapon, okay, in a crappy market environment. All right, because you don't want tension with your weapon. Now, going back to linearity, all right, you'll notice that this particular chart is a 3-minute time frame. Okay, well, basically, this is the same template chart you're going to have pretty much on all your time frames. Okay. Now, I call these the legacy charts. The legacy charts are the ones where we just use the regular market hours. Okay. So when it comes to the equities, the charts begin at 9:30 and they end at 4. All right. And those are done, or used to be done, a 1, 3, 8, 13, and a 60, and a daily chart. I know it seems like a lot, but just remember, you're just looking, you always want to start with the wider time frames and see if there is that mini pup pattern. Okay, when you see that mini pup pattern, then that gives you the permission, or that tells you, hey, why don't you investigate a little deeper and find out if the shorter time frames are at that point where they will trigger the wider time frame mini pups. Now, on Cobra IQ, okay, CobraTrading.com. It's very interesting, because I never really thought that you could get accurate charting on a pre-market or a post-market basis. All right, as far as post-market trading, I pretty much kind of winged it. Okay, stinky 250 levels, wider time frame support resistance levels. But as far as applying the stochastics moving averages charts, I didn't think that was possible. I thought there would be too many mystics, too infrequency of trades, skewing the data, all that stuff. Every excuse in the book. Okay. Well, interestingly, on this Cobra Trader platform, Cobra IQ, it's funny because when I was using these guys initially, I noticed that the charts were different than my Realtek charts, and I was like, wow, man, this is these guys have to get their charting straight, okay? But applying the same patterns, the pups and the mini pups, right? I stumbled onto something. Their charts actually run from pretty much 24 hours a day, all right? 24 hours a day, with the understanding that when the ECN's closed, then the data goes flat. So basically, their charts run from until 8 p.m. Okay, and then they'll start up around 6 a.m. All right. Now, with that information, okay, that does change the charts. The charts actually make a difference because you're talking about more data. Okay, the scope of the data, it becomes more accurate when you can include the pre and the post-market trades. Now, does it mean that you're not going to have whacked out trades and and the lack of the volume is going to screw up those charts? No, they're not going to screw them up. But what they're going to do is all that data is included, and as time moves on, okay, it still paints either the same picture because there aren't enough trades there, okay, or it gives you more of a heads up going into the market day, okay. The scope of the data being a wider scope of data, what that actually does is it actually makes the weapon more potent. And that's the word. That's the word. It makes it more potent, more dangerous, gives you more insight. And because of these charts, okay, and I experimented simply with a 5 and a 1 minute chart, okay, on the Cobra platform. And very, very interesting because I started looking at these charts in the pre-market, and one of my favorite setups is a 5 minute that is uptrending, okay, five period is moving higher, 15 periods moving higher, okay, stock peaks out, and then it just stalls out and starts to go sideways a little bit as a 15 period moving average is moving up, okay. That's called a pup breakout when the 5 turns back up. That's a moving average pup breakout, okay. But in that same vein, a lot of times the stochastics right underneath it will also stall and then slope up. And so what you'll get is a moving average pup breakout and a stochastics mini pup breakout on a 5 minute chart. And if you get a 1 minute chart that forms a mini pup as well, that's a super strong breakout. And the beauty about these 5 minute charts in the pre-market is that they update every 5 minutes. Every 5 minutes they update. So, sometimes I'll be in a trade and it's not going anywhere and it looks like this thing's gonna fall, and then 30 seconds before that candle closes, bam, they spike it up in that last 30 seconds so that when the candle closes, the moving average continues to march higher, you see? And literally, the minute before that 5th minute is where you see the action come in. They come in, they pop it, and they pop it, and they pop it. Like, this is amazing because here I am, I'm looking at these, I'm still waiting for 9:30 on these other charts, okay? And when 9:30 comes around, the most interesting thing is when 9:30 comes around, because we're talking about, the data's cut off from 4 from the prior day and then starts back up at 9:30. So the quote platform, if there's a gap, you actually have to wait, you have to wait for that gap to be recognized and the moving averages to catch up. So on a 3 minute time frame, oftentimes you're waiting at least 2 candles for the moving averages to catch up or catch down. Now during that 3 minute, 9 minute time frame I'm waiting, I would see this 5 minute chart already either in a mini pup, or here's the best part, when the 3 minute finally catches up, that 5 minute may have peaked, turned, and formed a mini inverse pup coming down. Okay? In fact, that chart was giving me so much insight and foresight, okay, going into the market day, I couldn't ignore it anymore. I absolutely could not ignore it anymore. And now, it was also because I was making money using that. In fact, I was making more money using that in the pre-market. And there's a reason for that, because once that 9:30 bell hits, okay, after the first 10, 15 minutes, traders get acclimated, but the programs get acclimated, the market makers get acclimated, all right? And the next thing you know, everybody is they're all pretty much playing leapfrog over each other for pennies, okay? The big boys they're trying to flush and reverse patterns that look great, because a trend failure is where they're going to get their most liquidity. That's where they're going to get the most liquidity in a thin market, okay, or a light volume market, all right? But these programs, they don't run in the pre-market, okay? So this is the equivalent of going to the beach going to Miami Beach at 6 a.m. with your metal detector, and basically just searching and finding jewels, finding trinkets, finding some jewelry. Every once in a while you find some jewelry, and finding your treasure before the tourists come back in. You see what I'm saying? Because after 9:45, the tourists are there. The tourists and everybody and all that junk, okay? So just something to keep in mind. But that's part of how I came up with, the rifle charts is what I call them. Now, this is the intraday legacy charts. Sorry, guys, but you're kind of old news, okay? The wide range legacy charts are the same thing, except instead of the 1, 3, 8, 13, 60, okay, I add a 60 daily, weekly, and monthly, right? That's all. 60 daily, weekly, and monthly. Okay. Treat them just like the intraday charts, but just know that they're the wider time frames. All right. The best part about the wider time frame legacy charts is because if you get 3 mini pups together, okay, that tells you that stock's going to break out. Okay, whatever it does intraday, it's still going to break out higher. This is where you can base swing trades upon. It's still going to break out higher. All right. If you want to play it intraday, you've now got the support of the wider time frames. Okay, Mother Nature, right? Jesus Christ is behind you. Okay, when you get many pups in these wider time frames, you're set. All right. In fact, that's when you may want to consider buying calls. Okay, buying calls on wider time frame mini pups, or buying puts on the flip side, mini inverse pups. All right. Okay. I'm just gonna move forward real quick and talk about these rifle charts because this is one of the most significant developments, with everything regarding the methods. And like I said, okay, the methods haven't changed, but by including the pre and the post-market data, okay, the methods are more effective because the scope, the line of sight, okay, has been widened to include more data. Now, obviously, if there's more trading going on in the pre-market because of news, earnings, or any type of development, they're going to be very useful. But on the flip side, also keep something in mind. Okay, stocks, thinner stocks are not going to be as useful. Okay, if there's no trades in the pre-market for a stock, then nothing's going to be that useful. Okay, but normally when the futures gap up or gap down, and the stocks that tend to follow those futures, the leaders in the NASDAQ 100 or the S&P 500, okay, they're going to gap up. When the futures gap up big, when the SPOOs gap up big, your Goldman Sachs is going to gap up. Your IBM is going to gap up. When the noodles, the NASDAQ 100 futures, when they gap up big, you usually get Apple and RIM gapping up. Okay, so the more heavily traded stocks, pretty much 90%, 99% of the time, you're going to have enough data and liquidity, provided if there is a gap up or down in the futures. Now, if the futures are flat, okay, well then you're not going to get anything playable. And that's the whole point here. Okay, we're not looking. We're trying to discriminate. That's the thing. Okay, we're trying to discriminate because if everything is looking good, then if everything's looking good, then your filters are too wide. Okay, it's about discriminating and filtering it down with effective filters. Okay, to find the highest probability setups. All right, to find the highest probability setups. So, like I said, these rifle charts, okay, they're not going to find you something. No, it depends on how hard you scan and stuff in the pre-market. Okay, there are times if you look at the SPY or the futures in the pre-market, and you see the SPY making a 5-minute pup breakout, well, that's going to, 90% of the time, Apple's going to be doing the same thing. RIM's going to be doing the same thing. Okay, so they're all linked. All right, they're all linked. But like I said, you're not going to find something to trade in the pre-market every day. And and I'd love to be able to tell you can, but you're not. Okay, but when that just makes it so that when they do happen, okay, it's going to be very consistent. It's going to have follow through, and I don't want to jinx myself, but it's going to be very predictable. Okay, and that's a word I don't like to use. I like to use foresight and foreshadow, but predictable. Okay, literally, you can time it on your watch by the 5-minute candle closes. All right, so the rifle charts, that's what they are. Now, the only difference is on the 1-minute chart. Okay, there's no 15-period moving average. I simply use a 5-period moving average. All right, on the 1-minute chart, and there's a simple reason for that. All right, when it comes to the mini pups, okay, and this is a mini pup right there. All right, all you want to look for in the mini pups is the 5-period moving average. This is a 5-minute chart of RIM, and a 1 minute chart, okay? Remember how a mini pup forms, okay? The stock is gonna take a bounce, it's gonna pull back, test that 5-period moving average, all right? When that 5-period moving average holds, okay, and the price proceeds to bounce, okay, that's where you get, let's say right here, if that 5-period moving average had broken, okay, stochastics would simply cross back down. All right, shorts are expecting, they're anticipating that to break, and that's why they'll come in and they'll try to they'll short it. And when it doesn't sink, they're the first ones. They're the first ones that are going to cover in a panic, and then we'll bring buyers off the fence. These are called mini pups. All right, so it's that 5-period, the 5-period. Now, I always do. I use the 1 minute as a trigger, literally. Okay, it's your trigger finger, and when you get the cross up, okay, and keep in mind the low band crosses, they're still effective. Just make sure you have an uptrend, okay, but they're still effective. All right, but when the 1 minute actually forms a mini pup, they're even stronger. Okay, so going back to being linear. If the whole basis of a mini pup being successful and forming is that it holds the 5-period moving average, okay, first of all, that's what forms the mini pup, but that 5-period moving average also is going to be your trail stop, okay, well, you know, why wouldn't it apply to the 1 minute, all right, and that's pretty much what I did, because up until I applied that 5-period moving average chart, okay, all we had were the Bollinger Bands, okay, and a 1 minute 20-period moving average. All right, and all that stuff in between. So basically, when the 1 minute forms that mini pup, okay, yes, we have room. We know where it's going to go to the upside, okay, especially on a 1 minute chart, okay, and we know that we have upside momentum. But wait a minute, what about a trail stop? Hey, well, there you go, 5-period moving average, okay. So when you get a mini pup on a 1 minute and a mini pup on a 5 minute, okay, that is a powerful pattern. All right, where do you get in? Well, you get in when that 1 minute forms that mini pup. The 1 minute's always going to be your trigger. Remember that. The 1 minute's always going to be a trigger. Now, one other thing you want to kind of keep in mind with these mini pups, when you look at the candles, all right, when you look at the candles, you want to always, whenever you get a succession of candles, you know, like green candles, okay, the mini pup's always going to form when you get a red candle that comes in, okay? Because you got the red candle that comes in that's trying to, you know, the sellers come in and they're trying to take this thing down. So whenever you get a succession of green candles, all right, look for the red candle as the first indication of a possible mini pup. That red candle is going to form, all right, red candle is going to form, you know, bam, bam, all right, to test it, all right, there's a mini pup, look at that. Red candle tries to form, okay, and then when the next candle comes in, all right, and they break through the body high, okay, of the red candle, that's going to be your buy trigger, all right. So if you want a more precise entry point, okay, it's going to be the high of the body of the red candle. It's real simple too if you think about it, because just assume this is where sellers came in, this is where shorts came in. Okay, so naturally they come in, and then you take them right back to, you know, the break-even point. Okay, well, you know, that's going to cause them to stop out, you know, and that causes the panic and more buyers to come in. Bam, mini pups, mini pups. All right. I just went back 3 slides. Don't want to skip this part. The trader's market versus crab. Technically. Fertile versus an infertile environment, because it's something that is very applicable right now. Like I said, with the so-called extra efficiencies in the markets, it's trimming the windows of opportunities out there. It's trimming the windows of opportunity out there. So you have to pretty much grab what's out there when the market is fertile. You can't sit around during that time, okay? And that's also one of the problems that I tend to see a lot of times with traders, is that, oh, they'll see, you know, I'll make some alerts, it makes sense, you know, they finally wake up around 11:30, you know, Like, all right, I'm ready to go, I'm confident, and then face plant, all right? Because the exact same setup that happened at 9:45, 9:50 p.m. when there was volume and when the market was lenient, okay, that exact same setup happens at 11:30, 12:30, 1:30, okay, during that dead zone period, or during the witching hour, which is between 1 and 2. All that does is they'll get in, expect the same thing, but there's not enough volume, okay? It's already been I don't know, everybody's been adjusted to it. The big boys, they see that, they're like, oh great, look at these minions. And let's just smash them, or let's just pull all the bids, let's just flash, So when you trade, okay, and being able to discern when a market is just crappy, for lack of a better word, that's half the battle, all right? So just to give you an idea of what an infertile environment is, all right, it's when you see a lot of choppiness, obviously, but the moving averages, they're not trending, all right? And the one thing that you have to remember, one rule with moving averages is that they're only helpful, okay, in the presence of a trend, okay? Because the whole purpose of that is the moving averages are to quantify, first of all, that there is a trend, and with that trend, it'll give you the supports on the trend, be it an uptrend or a downtrend, the 5-period moving average, the 15-period moving average. The other thing is the distance between the 5 and the 15-period moving average is called a trend channel, okay? So it tells you all those things. If the moving averages are flat and they're moving sideways, or they're constantly crisscrossing each other, it doesn't mean the stock itself isn't moving, all right? Oftentimes you'll see a lot of activity on your level 2 screen or level 1 screen, and you'll see the stock chopping, okay, but there's no follow through. All right? In fact, every breakout starts off identically with a wiggle that you'll see, in a choppy market. It all starts off the same. The only thing that separates the trend from a wiggle, okay, just like the difference between a hero and a coward, they both feel the same. The hero holds its ground, okay? With a trend, it holds its ground, all right? It holds its ground long enough for the moving average to, to curl up and then follow through and follow through and follow through. And one of the advantages of a mini pup pattern is that it doesn't really react, it doesn't really form, okay, and you shouldn't react until you get a trend that forms. Okay, a moving average, a mini pup allows you to step in on a trend that's already formed. It's formed, it's exhausted, it's taking a breather, and then it explodes again to the upside. The only time you want to play a mini pup when the moving averages are flat, okay, is when you use the foreshadowing aspect of that. In other words, a wider time frame is forming a mini pup. A 60-minute has a mini pup. Okay, 8 and 13-minute has a mini pup. But meanwhile, the 3-minute or the 5-minute is just chopping. Okay, in a situation like that, obviously, that's a foreshadowing situation. It's a Doppler effect, and you want to jump in on something like that. Okay, but if you've got your middle time frames, okay, like I said, your 8, 13, okay, or your 5 and 10-minute, all right, and when they're chopping, you just pretty much want to stay out. Okay, and it's, let me tell you, during the day, you may feel like you're just wasting time, but you'll thank yourself at the end of the day. All right, so an infertile environment, like I said, lack of trends, the volume is light, okay, a whole bunch of chop, but the moving averages don't have any follow through. And when you don't have follow through, you also don't get synergy. In other words, you don't get the tier 1 leaders that take off. I'm sorry, the tier 1 leaders may take off. First Solar, FSLR, may pop, okay, but SPWRA, YGE, the rest of the sector may not be doing anything, okay? Or you may get 2 stocks in the sector, a leader and a laggard, and then the rest of the sector is not moving. When you don't have that type of correlation, okay, because there's not enough volume and momentum in the market to affect the whole sector, and that's when you know that it's an infertile market, it's an infertile environment, all right? And these environments, okay, they can be seen on a macro level, okay, looking at your moving average charts, you'll see when they get flattened out on the daily, okay, it's just chop, it's infertile, all right? But it can also be seen on an intraday level as well. The periods, in trading periods, make a big impact as far as what's fertile and what's not, okay? And usually, most days, that opening action, the opening hour, all right, from the 9:30 to about 10:15, 10:20, that's where you're going to have your most liquidity, the highest volume, and that's where you want to be making your trades. Okay, all right. So basically, infertile market. Now, what not to do in a stank trading environment? Once again, more terms that just pretty much describe an infertile trading environment. Okay, the reason why I put these up here, okay, what not to do is probably because it's what you do, okay? And you probably already know that you shouldn't be doing it, all right? You don't want to use a heavy size, okay? And once again, you don't usually start off going heavy, okay, but after getting chopped enough times and you see your P&L getting eaten up, a lot of times from the commissions anyway, from the commissions and the ECN fees, all right, you may be tempted to add on more size, all right, and all you do is you're just doing yourself a disservice because basically you won't be able to get out, okay? You may get in on something and have a profit, but as soon as you try to get out, the bids evaporate, okay? If you ever have that happen to you, even once, get up, walk out of the room, walk out of the door, walk out of your house, your apartment, or whatever. Just get away for a little while. Okay, it's the bottom line. Because I believe that everyone that goes into the market day, all right, has a gauge. I don't know. You call it a sharpness gauge. Okay, and you start off ready and you're sharp. Okay, but the more you focus and the more you drag it out and you drag out the chop and the chop and chop, it wears you down. All right, and the market wears you down like that, and it's self-inflicted in all reality. All right, so when the market starts to get infertile, crappy, stanky, okay, all right, just do less, do less. In fact, out of sight, out of mind. Every day, I take a 2-hour break anyway. 2 hours, 2.5 hours. Sometimes I'll take a 3-4 hour break. Do I want to? No, not really, but I have to, all right, because I know myself, I know myself. I'm not the most disciplined trader in the world, okay? That's fine, I'll acknowledge that. I am a scalper, fine, okay? But, like I said, if I know that this environment has driven me nuts before, okay, I've gotten chopped to death before, I've had ridiculous commissions before, all right, then I know that I gotta find an excuse to get up and walk away. Find something to get up and walk away. Find a hobby or something. All right. So like I said, stank market. Make sure that you just get up and walk away. All right. Now this is where we get into the meat and potatoes of the methods. I've already explained and shown you what a mini pup is. Okay, this is what a pup breakout looks like, all right? And a pup breakout, like I said, is you got your 5-period moving average, okay? It stalls out. It's not as crisp and clean as a mini pup because you will have chop, okay, on the 5-period moving average. Okay, the shorts will come in, they'll win a little bit, the bulls will come back in, they'll pop it up, back and forth, back and forth, back and forth. But what you will notice is that 5-period moving average, okay, pretty much maintains a flatness to it, all right? A pup breakout forms when you get a stochastics that clearly crosses up and you get at least, at least 1 or 2 candles, okay, that pretty much close above that 5 enough to slope it up. You see that sloping up, okay? That's a pup breakout. That's a pup breakout, all right? And there's your mini pup breakout, okay? Once again, you get your green, green, red, all right? Green, green, red, and then the break of the high of the body of the red is your buy trigger. Mini pups, bam, okay? And then you just see how it just maintains steadily on the 5-period moving average from that point moving forward, okay? All right, pup pattern, once again, this is just a more detailed breakdown of a pup pattern, okay? Always get the stochastics cross. All right, a lot of times you'll see this, but the stochastics will be down. That's called a make or break. Until you get the cross up, okay, a lot of times it's just going to be a wiggle that comes right back down, and then the 5 period continues to go flat. So always get the confirmation with the cross. Okay. Mini pup, once again, 5 period holds. Okay, it gets challenged, it holds, and when you get that specific sloping pattern, okay, when you get that specific stall and slope, that's your mini pup, and that's when you want to step in, okay? And if you want to get technical, you want to step in, okay, above the high of the body of the last red candle. On the flip side, on a mini inverse pup, you want to get in on the low of the body of the red candle. All right, perfect storm. So when you get 3 or more mini pups, when I say 3 or more mini pups, I'm referring to time frames. All right, so you get your mini pup on a 3, 8, 13, 60, 13, 8, whatever. All right, all of these are always going to be triggered by the 1 minute cross. Remember that. Always make sure you get that 1 minute cross. Okay, as soon as the cross is over, all right, that's when you want to step in. One of the problems that newer traders to the method tend to run into is that they'll find these mini pups and they'll ask me if it formed a mini pup, and I'll say yes it did. The only problem is they'll find it up here. Okay, so the key here is always start with your wider time frames because they give you the foreshadowing heads up, so to speak. All right, so you always start off with your wider time frames, and when you see the pups form, okay, that's when it tells you, it's alerting you, hey, watch the lower time frames now, okay? Because once the lower time frame crosses, okay, it's like that movie Gladiator, how Maximus was like saying, hey, tell my men I'm still alive, and you'll see where their loyalties lie, and the 5,000 man Roman army will invade Rome, okay? Same thing, all right? You don't move until you get the 1 minute to cross over. And like I said, don't try so hard to focus on this. First, start here, get prepared, and then wait for the trigger to cross, all right? Because you don't want to catch a mini pup up here, because by that point, the transparency has been made apparent, and your window of opportunity to capitalize on that, to make money, is pretty much shut, all right? It's good exercise, spotting mini pups, but to actually play the mini pups, there's got to be some meat on the bones. So the key is getting in on the stochastics crossover on the 1 minute. All right, stars and hammers. These are my 2 favorite reversal patterns, reversal candles, all right? And basically, you just want to make sure that you have a succession of green candles, okay, prior to the hammer that forms, all right? If it's just one candle and you get a hammer, all right, that's not going to be good enough. You have to have a succession of green candles, all right? Now, in addition to that, keep in mind the Bollinger Bands are very important right there, okay? When you get a hammer, all right, the basic rule that I use, all right, if you want to keep it tight, is the low of the hammer, be careful right there. If that breaks, okay, you might have some troubles, all right? I'm sorry, the low of the body. But if the low of the hammer breaks, you want to get out, okay? One of my favorite setups is where you get the low band stochastics cross. And when I say low band, that means they cross through the 20 band, okay? You get the hammer, they cross through the 20 band, all right? And so then the targets are very simple, the bumpers, all right? Each of these is a bumper. You got your upper Bollinger Band, your 15 minute, your 5, and your lower Bollinger Band, okay? Every stock has 4 bumpers. So wherever that hammer forms, okay, the next bumper, all right, is going to be a target you watch. If it forms on the lower Bollinger Band, you want to watch for the 5 period bumper. If it forms on the 5, you want to watch for the 15 period bumper, okay? Now, once again, going back to the whole notion of of hammers, okay, and stars. It's an upside down hammer. You want to make sure you have a succession of green candles and then the star, okay. Right here you want to have a succession of red candles or down candles and then the hammer, okay. The key is you want to step in right at the body, okay, right at the body level breaking, all right. Now the beauty about getting a star or a hammer that closes right under the Bollinger Band is that you can then use that as a trail stop, the Bollinger Band that is. Okay, once a bumper gets a hammer, technically it's supposed to be sealed so that it doesn't break back through. If it does, you're out, but the probabilities are very high that it's not going to break back through. Okay, and then at that point is where you just let the stochastics take over. You come in on the short, you let it take over and ride that 5 period as a trail stop. Okay, and if that 5 period gets tested, you get a mini inverse pup if it holds. Okay. All right, dojis. That's another beautiful reversal candle that I love. And with dojis, I just think of line in the sand. Okay, doji is pretty much like a cross. That's all it is. You know, you have your tails and your wicks. Okay, but the open and the close are pretty much identical. So you have that little line right there. I love dojis because it's, well, basically it's a line that you can just pretty much extrapolate out like that, and below that line in the sand, okay, it's a reversal. Reversal to where? Well, what's the next bumper? You get a doji on an upper Bollinger Band, your next bumper is going to be your 5 period moving average. Okay, you get a doji on the 5, your next bumper is going to be your 15. Okay, and at each of these bumpers, you have to take money off the table. Now, oftentimes what happens is you'll get the doji, a move to the 5, it'll overshoot. Okay, stochastics will cross down, and then what they'll try to do is they'll try to bounce it back up through that 5 period moving average. When that 5 period moving average rejects, the stochastics will then form a mini inverse pup, which allows you to then look for a move down to that 15 period moving average. Okay, in fact, that's where mini pups tend to form on these bumpers because there's tension that comes in. There's stress that forms because you have a battle between the buyers and the sellers, and that has to resolve. It always resolves. Okay, and when that mini pup resolves, and it simply put, a mini pup forms. Okay, the 5 period moving average pretty much tells you who won. All right, and it also tells you that's going to be where your trail stop's going to be. Okay, with the next bumper being a target, be it a Bollinger Band or moving average. Okay, now technical analysis on the fly. Once again, going back to everything I just said. You know, if a stock falls during the day, all right, first thing you want to do before you jump in on it or anything of that nature is you want to pull up your wider time frame charts first and foremost. All right, your 60, daily, weekly, monthly. Okay, and based on all the bumpers, all right, 5, 15 period moving average, upper lower Bollinger Band, and then your 50, 200 period moving average if they apply. Okay, if the stock is trading anywhere near those levels, that's a bumper. It's a valid bumper that you want to jot down. You want to note that, hey, 69.50 is the weekly 5 period moving average on RIM. All right. Now, the severity of the bumper, okay, the sturdiness of that bumper there's 2 factors. First of all, if it's the wider the time frame, the more sturdier that bumper is going to be. Okay, but also if there is a mini pup. Okay, once again, what's the rule with mini pups, guys? What's the main? A mini pup has to protect what? The 5 period moving average. That's it. Okay, so if there is a weekly mini pup on a stock, all right, that means that weekly 5 period moving average is very sturdy. Okay, until they break it. All right, and if they break it, all right, once again, think about it. If the 5 period has a mini pup on a weekly time frame, you don't just break that out of the blue. You don't just break it on a whim. It tells you the veracity of the sellers that are in the stock. And the thing about trading is that, you know, a support, and if you're long, that support is a friend, okay? But if you're long and that support has a mini pup, that's your best friend, okay? But in this game, If they break that 5-period moving average, that support has now become a resistance. And your best friend has just become an enemy. He's just run to the other side, and he's just left you behind. And whose fault is that? Yours, because you should be racing him to the other side, okay? There are no friends in this game. All right, so the bottom line is that, once again, no matter how strong something is, if they break it, okay, the first thought is not, oh, wow, that wasn't that strong, okay? The first thought is, oh my God, the other side is stronger. Let me jump in. Let me jump to the other side as fast as possible, okay? Taking that same philosophy or that same thinking, all right, well, the most powerful setup that I have that I can provide you guys is this thing called a perfect storm pattern, all right, where you get 3 mini pups or 3 mini pups that are lined up. You time the 1-minute trigger, you're in, okay? Now you've got mini pups on 3 different time frames, which means you have a 5-period support, okay? Bam, 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 okay? Very strong. So what happens when that perfect storm gets muscled back down the other way? What does that tell you? That tells you no matter how strong a perfect storm is, okay, the other side, the sellers are even stronger. You see what I'm saying? If they can defeat my greatest weapon, what am I doing still on this side? Okay? I've already paid for that knowledge because, you know, you take a stop, obviously, but you got to switch sides. All right? You got to switch sides because it takes a lot to break a perfect storm pattern. Okay? And that's the one constant here. If it's your best weapon, okay, it's going to work, but there's going to be times, all right, where it's going to be muscled back the other way. And that's just as good as a perfect storm, a defeated perfect storm, because you're going to get follow through on the other side. Because there's going to be a lot of other disillusioned people with their jaws on the ground, and they're slower than you. So they'll all be selling on the way back down, all right? So, like I said, if they're stronger than you, join them. Okay? If you can't beat them, join them. All right, pre-market preparation. Exactly what I talked about with the doing your analysis on the fly. Okay, and it takes less than 5 minutes to just run through the wider time frame or the legacy charts. Okay, just jot down your levels. Is there a mini pup? Yes, great. Check that off. Is there if there's a mini pup, where's the 5-period moving average? Okay. Is the stock trading near a monthly upper or lower Bollinger Band or a monthly 5,200 period moving average? Okay, if there's a monthly mini pup, is it trading near that 5-period moving average? Okay, the bells should be going off because the monthly, that's going to be your strongest time frame. Okay, it has the most depth. You take a mini pup, that's a powerful pattern. The 5-period moving average is a powerful support. Great, I need to jot that number down. All right, now, here's the best part. If that monthly 5-period moving average support also overlaps with a weekly 50-period moving average or a daily 200-period moving average, do you see what I'm saying? All of a sudden, now you've got 2 powerful overlap support levels. Okay, that's what I call a galvanized support level. Okay, the fibers, you got steel fibers meshed with carbon fiber, I don't know, and it's a super strong support level. Okay, so when you see something like that, well, what comes? If I tell you that there's a super strong support, right within 50 cents below, well, what are you going to be thinking about doing? Well, hey, if it's a super strong support, let me go ahead and throw some bids in there. Remember, like I said, ahead of time. Think ahead of time. Throw some bids in there in case they panic it real quick. Chances are that's where you're going to have at least a defense and a bounce. Okay. Now, once again, what if they break that support? What does that tell you? Does it tell you that the methods suck, they don't work, and return the DVD? No, hopefully not. What it tells you is that as strong as that support is, if they broke that support, I need to be on the other side and apply everything towards the downtrend. Because chances are most likely you probably have a perfect storm that's been setting up intraday on the shorter time frames. Okay, these patterns and the stochastics, moving average, moving average charts, they're dynamic, okay? They're not static. So as the price forms, as a trend forms, or if it doesn't form, if it reverses, it's like an exoskeleton. It's going to adapt to it, okay? And so, you know, if you're long a perfect storm, ultimately, you're going to end up, when it breaks down, you're going to end up pretty much either with a perfect storm or at least two mini pups going the other way, all right? But the fact that you were already in it and you felt it, okay, that kind of gives you a heads up. And if you've and that's where you're really paying for the knowledge, all right? That's where you're paying for information if you choose to take advantage of it, okay? So, going back to the pre-market preparation, I call these core stocks, okay? In the past, I used to call them basket stocks, all right? But you know what? Like I said, with the mutation of the markets now, you don't get that very clear tier synergy, all right? In the past, you know, everything starts off with the futures. If you can imagine like a pyramid, all right? Gee, the market's in a pyramid scheme. Who would have figured, right? But a pyramid, and it starts off with the futures, all right? And then you have all your sectors. You have your tier one general. So you've got your sectors, you know, you got potash, you know, with the fertilizers. You got pot, you got, you know, Mosaic, MOS, MON, you know, your semiconductor, your semi makers, your CLAC, AMAT, CLIC, you know, and you can just go down with each sector. And each of these sectors, they make up, you know, the combination of all these sectors, they make up the market as a whole in general. And you used to have very defined, you know, stocks that were, you had your leaders, you had your second tier leaders, or, you know, your third on down to your laggards and your turds, all right? So if one sector is super strong, it would pretty much string along the rest of the sector, okay? You get a lot less of that these days, all right? So when I call them core stocks, they got to be a little more than just somewhere in that sector. They actually have to be correlated directly with the futures. We don't want to take any more chances here. So that's why these core stocks have to be stocks that are either, you know, they're in the S&P 500 or the NASDAQ 100, because then they're part of the cash, you know, the program buying and selling that's going to directly, you know, push and pull these stocks along with them. So core means, you know, your core stocks, your bread and butter stocks, but they're also correlated, okay? And the futures are always moving. And the futures are breaking out. Your core stocks are going to get dragged along because they're right up there in the upper echelon. They're lodged, embedded into the index, all right? So pick 3 or 4 core stocks, okay? You know, something like, you know, an Apple, Amazon, Goldman Sachs, you know, decent, you know, 3 core stocks. And every day you want to do exactly as I said, and go through each of those levels. Now, you know, the monthly is not going to change that much, all right? You know, but the thing is, your daily and your 60s are, okay? So that's why you just want to keep adjusting, you know, keep doing your research. You can throw it up pretty much on an Excel spreadsheet or just jot it down, make sure you can read your handwriting, all right? And have those core stocks there, okay? On top of that, and this is really, you know, during earnings season, you get a lot more gappers and dumpers, okay? But, you know, you'll find, you know, you find, you know, 1 to 3 stocks that are gappers or dumpers, or that are new gap ups or down, okay? Especially if the futures are flat. Okay? If the markets are flat, then your core stocks aren't going to do that much. Now, in that first 45 minutes, they'll oscillate, okay? But if the futures start to chop and go flat, all right, that's, once again, that's where the crappy market environment comes in. That's where Apple's going to pop 2 points and RIM's going to drop a point, and Amazon's going to, you know, chop within a 3-point range, okay? You're not going to get that correlation. So instead of trying to, you know, fix your mousetrap, which you don't need to fix, you just go and find another mousetrap, okay? So that's your pre-market preparation. As far as the trading day is concerned, okay, this goes right back to the whole market environment, all right? What's consistently, the opening hour is going to be your most fertile period, all right? Even if the futures are flat, a lot of times, because the market's just opening, you know, the market makers are lenient, everybody's a little, you know, jittery, whatever, all right? And because of that leniency, you're gonna be able to make money. If you lose money, you'll be able to at least make it back. Okay, one of the problems with this market, this mutation, is that if you take a hit in the mornings, okay, a lot of times the best you're going to be able to do is just chop away at that red, okay, and get back to even. All right, that's just the way this market is, and so I can't stress enough that you got to play that first opening hour. Now, the pre-market period, okay, beachcombing, all right, treasure hunting. Now, be diligent and look for this stuff. Every single quote platform has a gapper and a dumper. Most NASDAQ or NYSE most active. Okay, but you have your gappers and your dumpers. All right, stocks that are gapped up multiple points or gapped down multiple points. Okay, anytime you get action, all right, those 5 1-minute rifle charts, they're going to be right, and they'll be right dab into the middle of it. Okay, and those are opportunities that you want to watch. Okay, and pretty much depending on how much how diligent you are, you should be able to at least capture 1, 2 good pre-market trades every week. All right, and during earnings season, I mean, wow, you can quadruple that. Okay, during earnings season, especially with the more widely traded stocks, especially your Apples and your RIMs and your Amazons, because there's so much volume, and you don't have that program trading nonsense in the pre-market. All right, so take a look at it, guys, on Monday. Just take a look at any of these gappers, especially the stocks that have had the earnings the prior night, and you will see how absolutely how clear the trends are. Pull back to the 5, they hold it, bam, you got the mini pup, and bam, bam, bam. If it looks like it's not moving, always give yourself until that, always watch that clock. Right around that 4-minute mark, okay, that's when you'll get that little burst of buying that comes in that perpetuates the trend, okay? And usually this pre-market stuff, the most fertile times to really play is between that 8:30 and about 9:10. Okay, that's where you'll be able to get the most meat. All right, now after the opening hour, okay, it's going to vary. Some days you'll have some action till about 11:30, 11:15 if you're lucky. All right, but then that's when you get the dead zone period that comes in. Now, this is not to say that during dead zone that you don't have trends that break out, okay? You do. A lot of times you absolutely do. Problem with the dead zone is that it's an optical illusion, okay? Because what happens is, remember, it's not about just finding a stock that's trending, okay? A stock that's riding the 90 band, overbought, and it just keeps grinding and grinding and grinding higher, okay? Well, yeah, the stock is moving and it's grinding higher, but oftentimes it's a situation where it's too strong to short, but it's too overbought to go long, And what happens when you do go long? That's when they pull the rug, that's when they rug pull it, almost as if they're waiting for you, okay? So that's the thing. The tradability in dead zone is very tough, whereas in a more fertile environment, or during that opening hour, okay, you will get those you'll get that opportunity to be able to get in. The window of opportunity will still be there. The problem with dead zone, where they will grind, it starts off as a hammer, they pop it, they reverse it, and it just, and it looks like nothing's happening. When they actually jam it is when everything is riding the red line, okay, the high bands, where, simply it's not something that you want to chase in dead zone. But the more you watch it, the higher it goes, okay? And you've got the oscillation players, they've come in, and they're like, this is ridiculous. I'll just short some more. I'll just short some more. This thing's got to come back down. And what happens? It's a self-fulfilling, prophecy. It continues to go higher. You see what I'm saying? So don't let the illusion of dead zone, where you see stocks rising, okay, if you actually take a look at the charts, you'll realize wow, this thing is they're just grinding it, but they're not giving me an entry because they're not giving me mini pups. They're just grinding it out, okay? It's an illusion. You won't be able to consistently play that. Now, what will be consistent is that you will consistently get chopped, you'll get frustrated. What's even worse, what's even worse than getting chopped in dead zone is when you're trying to be prudent and you get in on an uptrend that, although it is overbought, it rises a little bit and then they rug pull it on you. Okay, so then what tends to happen? Well, all right, okay, well then the trend's over, fine, forget about it. I'm strong, I can handle it, I'm a big boy, let me reverse and short it. And as it turns out, it was just a wiggle. All right, that's where you should probably gotten in. You see, it's frustration. And a lot of times you'll have patterns that form in dead zone, like I said, identical to the morning pattern, okay? Or you get mini pups and perfect storms that will form in dead zone, okay, because of the lack of the volume, you don't get the follow through. So you may find that perfect storm forming, okay, but there's no volume. And as you get in and they muscle it back down, or it just wilts back down, it'll form again in the last hour. And what tends to happen? Well, you'll say, you can't fool me this time, buddy. I'm not jumping in. And what happens? The volume comes in and the thing explodes. Okay, so dead zone, even if you don't do anything and you don't play it, it's already messed with your head. You've already got subconsciously a frame of reference, that's already going to identify, and tell you, hey, this same pattern happened in dead zone and it reversed or, it fell apart. All right. The worst thing is if that pattern forms and you come in and you short it because you think you're smarter than the average bear. Okay. And the key was there's no volume. Okay. If there is one kryptonite when it comes to pups and mini pups, okay, and perfect storms, it's volume. It's volume. In other words, when that 1 minute crosses up, the volume should explode. Okay? If that volume doesn't explode, then one of two things is happening. All right? Either it's the other side is very strong, okay, and consider reversing, or it's just wilting because there's no volume and there's no follow through. All right? So the volume is important. Even if you're going to switch directions, the volume's got to be there. Okay. All right. So anyway, your dead zone, 12 to 2 p.m., 11:30 to 2 p.m. All right. Same thing. You'll know. The volume just thins out. Okay. And like I said, even if they trend it, and that's what they want to do. That's why I call the 1 to 2 p.m. the did I say that? Stay the FM. The 1 to 2 p.m. the witching hour, because a lot of times you'll come back from lunch and you'll see the market has been grinding higher, and you'll have this illusion that, hey, let me try to capitalize on it. It looks like it's going to continue higher, and during that 1 to 2 p.m. time frame, and that's where they get the last of the suck outs. The people who are just getting back from lunch and they want to ride the trend, and they may let it go for a little bit, but they're going to pull that sucker right back down. All right, so the best thing really to do is the last 90 minutes, okay, 2:30 on, 2:30 on. All right, that's where you want to look to re-enter and play the market. All right, now, as far as the intraday setups, okay, we've already established what a mini pup is and a pup is, all right? If you string along 2 mini pups, that's good and that's strong, all right? 2 mini pups, always with a 1 minute stochastics trigger in the direction of the mini pup, okay? Well, that's a dual pup and a mini pup pattern. That's strong, okay? 3 or more mini pups, and you've got yourself a perfect storm, all right? That's the best kind of setup you want to find. Now, how often do perfect storms happen? Well, it depends on the environment. Okay, if the volume's light, perfect storms don't happen that often. If the futures are chopping flat, you won't get much by way of perfect storms. Okay, when the volume's heavy, okay, you'll get more perfect storms. If the futures or the SPY is forming a perfect storm, see, this is where it's raining money, because if the index futures form a perfect storm, that means literally every tier 1 general is forming that same perfect storm, okay? And that's when you want to actually just raid it, just start nailing with the 1 minute crosses. But you can literally close your eyes and just watch the futures and hit a long on Apple, okay? And it'll work. Does it happen all the time? No, that's the thing. That's the beauty of perfect storms. They're valuable because they're rare. The rarity in and of itself is what gives it value. And when it happens, it's explosive, okay? That's what you want to look for. Now, during earnings season, you get a lot of action and you get a lot of volume. And you tend to get a lot of perfect storms that form just as well. Gappers, dumpers, they tend to form perfect storms. Any place where there's a lot of activity is when you can find perfect storms. When that volume thins out, okay, and you don't have trends and you got moving averages that are flat or crossing over each other, okay, no perfect storms, all right? And once again, you know, don't be bummed out because you're saving your capital, number one. Number two, you don't want to be playing all the time. Okay, it's just like playing poker. Okay, it's just like playing Hold'em. All right, the pros are the ones, because ultimately everybody gets the same cards. Okay, you have your peaks and valleys when it comes to your cards, and the pros they're just simply able to weather the valleys. It's not about hitting the peaks that hard. Okay, the difference between a pro and an amateur. They may both hit the peaks hard. Problem is, when the valleys inevitably come in, the pros, they pull back. The amateurs are going to keep going at it, okay? The more you throw away, the closer you get. The more you throw away during that valley period, the closer you get back towards the peak periods, okay? Just keep that in mind. You want to throw away more setups, because if you focus solely on throwing away setups, if you focus on being a Grinch, okay, and you know, basically just pretty much, you know, assuming all setups are pretty much garbage, okay, what you've inadvertently done is you've already set a very tight filter for yourself, all right, and that's a good thing. All right, this trade checklist pretty much goes through everything I just talked about, okay. Make sure you all print that up. It's I just threw some example stocks in there, okay? But the trade checklist pretty much speaks for itself. You know that the perfect storm, 3 or more time frame mini pups, that's going to be your best setup, okay? That is your best setup. Once again, okay, I've already established what's the best setup, guys? Perfect storms, right, exactly, all right? So it only goes down from there, okay? So I've already given you the top of the cream of the crop, the top, all right? So, you know, if you want to filter, if you want to make money in this game, okay? If you want to keep money in this game, all right? Making it is one thing. Keeping it, that's the harder part, all right? You will just narrow everything down to a perfect storm. Now, you know, if I were to give you an accuracy rating as far as perfect storms, you know, basically making money, being profitable, okay, I'd put it up there at 90%, all right? As long as you get in on that 1 minute trigger, okay, 90%, you're gonna make money. You're gonna make something, all right? You know, if you're, once again, you know, if you're looking for a dollar every time perfect storm forms, well, that's, you know, that's apples and oranges, because $1 on Cisco versus $1 on Apple are two different things, right? And that's the other thing you all have to keep in mind and understand and remember. It falls under the whole management concept, is that as much as patterns are linear, okay, and stocks have to be correlated, all right, when it comes to share size and allocation of the share sizes, even starting from, you know, when you first just go to cash with 100 shares, okay, that's not linear, all right? In other words, playing 100 shares on the QQQs, okay, and then playing 100 shares on Apple, all right, that's madness, okay, because Apple moves a lot more than the Qs, all right? A very simple way to do it, guys, is just, you know, go to Yahoo, pull up the, punch in the symbol, go to stats, key statistics, and look up the beta. The beta, okay? The beta gives you an idea of how many times the index, the stock moves, okay? The higher the beta, the less shares you got to use, all right? So, you know, off the top of my head, for every 100 shares you play on an Apple, okay, you can play, 300 shares on RIM. All right, but you've got to keep that in mind. All right, for if you play 100 shares on Apple, all right, you should be playing 500-700 shares on the Qs. Okay, now when a person just hears that initially, they're gonna be like, "What are you crazy? 100 shares or 700 shares?" But look at the range, look at the beta. all right? That makes the big difference. And that's the difference between someone who has 7 winning scalps and then that one losing trade that wipes out all the gains, okay? So you've got to stay consistent when it comes to share sizes by not being consistent. by discriminating via the beta, okay? All right, this quick analysis, once again, we went over this. Time frames. Go through the time frames. Check out the trend, yes or no. Okay, if there's a trend, all right, then the bumpers. Are there any overlapping bumpers? All right, and that's the intraday. The wider time frame frames. Okay, you would just instead of daily 60, 15, 5, 1. All right, you would switch that over to a 60 daily, weekly, monthly. Okay, same thing. Just check them off. If there's a trend, okay, all right, great. Where's the nearby support resistance? All you want to do is circle the ones that are overlapped within a 20, 30 cent level, 20 cent range of each other. All right, and if there's a mini pup, all right, give yourself a gold star. All right, because if there's a mini pup, you know the 5-period moving average is a solid support. And if that overlaps with any of these other support resistance levels, especially the wider support resistance levels, okay, then give yourself 2 gold stars because that's an extra embedded support. Okay, and that's a spot it's just like casting a net. That's all it is. It's you guys watch Deadliest Catch, right, on A&E. Okay, just throwing the crab pots over. It's exactly what you're doing. Just throwing the crab pots over in case they hit. Does it mean that it's going to hit? It's going to go there? Well, there's no guarantee that you're going to hit a double, triple support level, but man, if it does hit, all right, well, you've already seen ahead of time that it's a double, triple support, galvanized support level, and you're due for a hammer, okay, and a bounce, okay, maybe a short-lived bounce, but hey, you'll get a bounce. And the best part of this, you got it at a discount. You didn't pay retail. You didn't chase it. All right, you got it wholesale. All right, so there's your quick analysis. I went over the order execution. Once again, the whole point of throwing in a bid and an ask, a bid to get in long, an ask to buy on the long, to sell on the long side, okay, is it just makes you plan ahead. Now, naturally, most of the times you're going to pretty much have to just take it on the ask, especially when you've got a perfect storm lined up and you're waiting for that 1-minute trigger, that cross, okay? The closer you are to that trigger, all right, the more you're going to pay, obviously, but it pays to get confirmation too. That's the other thing, all right? It pays to get the confirmation, which means that you need some other guinea pigs to come in, hold that support, and then when it bounces back up, when the momentum goes back up, you want to jump in. But always try to sell. Always try to exit your positions on the inside ask, okay? And the main benefit of that, naturally, is going to be your ECN rebates, okay? Because those things do add up. The ECN costs, they absolutely do add up. And try to sell on ARCA, okay? Try to buy on Island, sell on ARCA. I don't get filled that great on ARCA when I try it on the bids. So anyway, if that's what you want to do, you want to actually try to provide some liquidity so that you can get your rebates. All right, one other thing as far as order entry, I like to have 2 order entry screens up, per stock. Just one is to get in, and the other is your backup in case they pull the rug or jam it or whatever. Okay, you can just click it and get out. Simple as that. Yeah, pretty much. You always want to make sure you have a backup. Now, one more thing here. Okay, if you are in the if you have this bad habit of selling too early, okay, that's a great habit because what you're doing is you are spotting liquidity and you're selling into it. If you're consistently getting out, okay, 90% of the times, right, 70%, 60% of the times, all right, and the stock continues to move higher after you get out, don't get frustrated, okay? The name of this game is spotting spotting that liquidity. And if you're selling into it and it continues to move higher, you are ahead of 95% of all the traders out there. Why? And the number one complaint was, well, Jay, you know, I can't make a living on 100 shares making, you know, 17 cents when this thing, you know, jams up, you know, 50 cents higher. I'm like, yeah, right. And you won't make a living making, you know, 50 cents on 100 shares, because most of the times getting that 17 cents, okay, is, you know, out of 10 good trades, you may get that six out of 10 times. How many times are you going to get that 50-cent move? Maybe once or twice, okay? So keep in mind, it's not about staying in there for as long as you can. The longer you stay in there, you go in with the mindset of, hey, I'm going to be static, and I'm going to use a static trail stop and a static gain, all right? And I'm not going to budge from that. Well, you cut yourself short, okay? The key is scaling. The key is to get consistent enough on the 100 shares that you can get it up to 1,000 shares, that you can get it up to 2,000 shares. Do you guys understand? Okay, there's a guy in my chat room, been with me since day one. He goes by the alias Dodge, okay? But he scalps Apple, you know, every day, all these, you know, usually maybe 3 or 4 trades, and he averages probably 8 to 12 cents. But he's playing 2,000 shares, okay? And he's very consistent. And, you know, he always gets out early, okay? But that's where getting out early matters. That's where it counts, all right? If you can take 7 to 12 cents consistently on RIM, consistently to a point where you're kicking yourself because you're always getting out early, forget about it, okay? That doesn't mean try to stay in longer. That means up your shares, for Christ's sakes, right? You want to really make money. You've already ingrained in yourself the ability to get out early. That's a beautiful thing, because it's better to get out early than to get out late, obviously. Okay, but now at that point, you've already hit a certain level, a level most people are not going to hit. Okay, man, you're natural. Up the shares, up the shares. Simple as that. Now here's the problem. When I tell them to up the shares, okay, you know, up them more, up them. Well, I don't know if I want to do that. You know, I don't mind sitting around with 100 shares and getting, you know, 17 cents, even though it ain't money. But, you know, I get up to 1,000 shares. Well, that's, you know, I don't want to lose that. Well, all right then. All right. Well, up them incrementally. But do you see what I'm saying? Okay. If you can consistently get out early, you're 3/4 of the way there. All right. Now it's time to up the shares, gradually, gradually, gradually. All right. The pump release method. Okay. Just like when you're driving your car in the snow, all right, and all of a sudden you realize that you no longer have control of that car, okay, and you're sliding. Well, what do they tell you? Don't slam on the brakes, because don't slam on the brakes because you'll completely be out of control. Okay, they just tell you to pump the brakes, pump the brakes, pump the brakes. All right, with that type of same rhythm, so to speak, okay, I've developed this thing called a pump release method. In that, all right, and I'm going to go to the next slide, okay, but the pump release method, this is going to kind of explain it. Going back to what I had said earlier at the beginning of this session, when I said every one of you already know what your tilt level is. That point at which you go over that, man, you start doing everything wrong. You start doubling, tripling your share size. You start going into trades where there is no trend, where it starts chopping. Okay, so there's that level where you will tilt, all right? And then there's that level right below that where, all right, you can manage it, you know, $50, I don't know, you know, $200. You know what? You can manage it because there's been so many numerous times where, you know, you've been down and it's come back, you know? So you have confidence in that, okay? So that's a level where, you know, up until that point, okay, you can still maintain control, okay? Now, on the flip side, there's a level where you can consistently pretty much hit early, all right? And it's not the end of your day, all right? You're up, all right. Well, you know, we're still working. You know, it could be $100, you know, it could be $400, $500, all right? But there's a level that you can pretty much hit easily. In fact, they're pretty much identical. You see what I'm saying? You know, 200 down, 200 up. That's pretty much the range, okay? Now, when you break through that 200 mark, okay, and you get to, say, the 400 or 500 mark, now, another interesting phenomenon happens, because once you normally hit that level, okay, I call that the plateau level, because at that point you're thinking to yourself, all right, well, it's just house money. And that's where people start to get a little more sloppier, because they figure, all right, well, you know, I'm above my 200, 300 point dollar range where it doesn't really bother me that much, you know, up or down. But now I'm at 500. And at that point, it's like, well, all right, let me take a little more risk. It's house money, okay? Now that's called a plateau level, all right? And what tends to happen at the plateau level is people tend to get a little more, well, sloppy, for lack of a better word, okay? They figure, all right, I'm in control. Let me just drop my shares, but, you know, hey, that's a mini pup. Let me take that. Oh, hey, good job. Oh, hey, there's a mini, oh, man. All right, no biggie, no biggie, no biggie. And then it chips away, chips away, chips away, until it drops right back down to that buffer range, okay, where it doesn't really matter. The problem is, when you're already up money from the plateau, when you give it back, all right, technically, you know, you're thinking, wow, I'm down 300 on the day, or I'm down 200 on the day. You see what I'm saying? And so what tends to happen is when you get back to the daily goal level, okay, and this level, it's actually magnified. Because to make money and then to lose it, okay, it's a lot worse than never making it at all right? And that applies to a lot of stuff. So anyway, you get back under this level, then all of a sudden, okay, once you go red, all right, that's when you just can't take it anymore, and you go harder and harder, and then the abyss, okay, well, this is the tilt zone, all right, and once you hit that, then right into the abyss, okay? Now, I'm not just talking about myself, all right? Okay, can I get an amen? Anybody? All right, all right. So, going with this model, this daily trading model, those numbers that you know that you're keeping to yourselves, okay, plug them in. So, this containment zone is the, you know, I don't really care level. It doesn't really bother me if it's on the downside. Oh yeah, I can make that easily on the upside too. That's your containment zone, okay? That's your containment zone. And your comfort zone, all right? Make sure you put those numbers down and be honest, okay? Put those numbers down, and then from that point on, every one of you has a plateau level, and you have a, well, you have a tilt level. It's the same thing, all right? And understand that once you break that containment zone, you get to the plateau level, okay? Every inch you fall back actually magnifies to 2 inches, okay? It double once you get back to the containment zone. And if you go negative, forget about it. So in essence, once you hit the plateau, what you want to do is you want to, like a trail stop, bump up your containment zone, okay? Just bump it right back up, you know, either to neutral or better yet, back to this level, the daily goal level, okay? Now, in order to break through the plateau, all right, what you actually want to do is trade less, not more, less. Now, this goes against a lot of books and a lot of theories where they say, hey, if you're trading hot that day, just keep pushing, okay? If you're in the zone, okay, just keep pushing. You know, no guts, no glory. If you're in the zone, just keep pushing, all right? And in theory, that may be great, but we're in a mutated market right now with a lot of fallout, and it's only going to get worse. So in other words, you may have been doing great in the morning during that fertile environment, but inevitably, that environment, okay, is going to turn right into an infertile environment. And if you go in with that same mentality that, hey, what I made in the morning, I need to keep pressing that, well, that's how the market gets you. It comes right back down. Do you see what I'm saying? So instead of hitting the gas, hit the brakes. Hit the brakes, trim your shares, and it's almost like just, I don't know, it's kind of like just, now you got that lump of clay, you hit that plateau, now you just gotta kind of carve away at it, just carve away at it, little pieces, you know, and just create the shape of the sculpture, okay? And you just take it really light, and believe it or not, when you do it that way, that's when you can actually break out to the next level, okay? Intraday, that is, all right? And you break out to the next day. Okay, and so that's what I call the pump release level. You know, you gotta just pump it, and gradually get it through that plateau. I mean, this right here is like it's like an upper Bollinger Band. You see what I'm saying? All right, it's like a Bollinger Band. It's a natural plateau. And what happens when a star forms at an upper Bollinger Band? Stochastics move back down and does what, guys? It sells off. Okay, all right. So when you get to those levels, slow it down. See, the worst, when it comes to the markets, when it comes to a stock, okay, the only way a very sturdy overlap galvanized support level or resistance level can break is slowly, the slow grind, the slow, tight, methodical, irritating, frustrating, grinding, choppy, grind that just grinds through, okay? It's boring as hell, but guess what? That's the only way you're gonna be able to break through, okay? If it's a fast pop, okay? If it's a fast pop, all right, well, that's how stars form. That's how a star forms, and you get the exhaustion, okay? It's gotta be a slow grind. So anyway, there you go, daily trading model. Pump, release, you know, practice, go out in the snow, pump, release, slow. Don't just hit the brakes. Don't just hit the gas. All right, and lastly, the Simulive method. Now, going back to what I was talking about, the simulator, taking away, well, basically taking away your access to blowing your own cash, okay? One of the things that I found works, okay, to prevent blowing out, all right, but yet, you know, still staying in the markets, okay, is to alternate between your cash and a simulator account, all right? In other words, hit that daily goal, hit that, you know, get towards the containment zone area, okay? But switch it over to the simulator, okay? Switch it right over to the simulator whenever the markets start to get choppy, okay? Or whenever you have what's known as a make or break. A make or break is where you have, well, a pup form on the moving average chart, but the stochastics have crossed down and then stalled on the stochastics. So in essence, you have either a mini pup that's about to form, or if that mini pup crosses up, you have a pup that's about to form, okay? And a lot of times, you know, we may step in and go long, and then all of a sudden realize, oh, darn, the mini inverse pup formed, okay? Well, if you're one of those people that have a hard time reversing a trade, all right, thinking, well, maybe that's a head fake, okay, then you definitely need to switch it over to a simulator. The cash is your real ammo, all right? Cash is your real ammo. Intraday, the worst thing that can happen to you is to run out of ammo. And that means being stubborn, and continuing to add to a bad position, but let me be a little more specific. Continuing to fight a perfect storm, continuing to keep shorting something that is trending up on all the time frames. To short something where you have a 15, a 5, and a 60-minute pup, a 15 and a 5-minute dual mini pup, okay? That's, you know, once again, that's not just generally telling you, you know, that's just, you know, short, that's just, yeah, that's just putting, you know, throwing good money after bad, and you know, no, you should be long, okay, not short. You should be long, okay. And if you have a problem doing that, well, short it on the simulator. Short as much as you want, okay, and play the other side. All right, it's just all a mental game. All right, it really is. It's all mental. Maybe I'm just being mental. But it works. It does work, all right? And it also gets you not to focus so much on your P&L. You know when you don't focus so much on your P&L, okay, when you're making money, all right, okay, when you're, well, actually, let me take that back. When you're in that containment zone, okay, remember, just like I had talked about, all right, hey, you know, if you're used to a $300 up and down range, that's when you don't really focus so much on the money. When you break that range, either up or down, okay, that's when you start focusing on the P&L. When you start focusing on it worse is when you break that range and then re-enter that range, okay? Then everything gets magnified double. Everything speeds up double, all right? And the simulator is what can kind of buffer that. That can kind of come in and, you know, and once you are about to fall in that range, you know, just jump onto the simulator, okay? It's a good tool. It's like a walking stick, you know? It's a good tool. If you do it right. And understand that the simulator, it's not meant for you to, you know, well, I mean, technically you should use a simulator as if you're trading, you know, live cash, as they say. But no, I mean, honestly, use a simulator so that you can get, you know, get all your bad habits out of the way, okay? And not mess with your ammo. All right, so anyway, that's going to wrap it up. If you guys want any further training, you all know about the book. It's out, 10 years in the making, 20,000 hours, a lot of pain, but it's out. It's like giving birth, or trying to give birth for 10 years. It's finally out. I feel great. Okay, so it's out. I hope you all enjoy it. And if you have any questions, always feel free to email me, jay@undergroundtrader.com. We have a full real-time chat room that's been doing from day one, intraday market analysis and alerts. You can get all the details on that on the website, undergroundtrader.com. And coming soon, we're going to be rolling out a new service, and it's we're going to put everything together. Okay, all the intraday stuff together completely in a portfolio trading swing trade system. All right, I'm real excited about that, and that should be coming out relatively soon. So everything will finally come around full circle and be complete. Okay, all right. So any questions? Yeah.
Yeah, Jay, on the DVD that they have out for your level 2 warfare trading.
Right, on the level 2 warfare trading.
One of the points that you drove home about your trading is to stay really focused during those trading times when the market's active.
Right.
I just wanted to point that out because after I watched that DVD, I incorporated that into my trading system.
Right.
And it works.
Right. Thank you. Thank you. Yes. And like I said, some things don't change because obviously the markets are. It's always going to be the marathon, you know, intraday. So when given the reality that the market's going to have a peak volume period, you know, and then you know, a peak and a valley volume period, you know, predominantly most of the time that peak volume period is going to be in that first hour, and it's going to thin out by lunchtime because people have to eat. And then it's going to come back towards the end of the day. So as far as that hasn't changed too much, you know, thank God. But yeah, that's been one consistent point. But yeah, well, I'm glad it works for you. Thank you. It should still work. Okay. All right, gang. I just want to thank everybody for coming out, and it's been my pleasure and my honor. And thank you so much. And I wish you all success with your trading and everything in general. Thank you.